everyone, welcome back to the channel. Ultimate Beginners Head and Shoulder Trading Course Lesson 5. This video will demonstrate how you can trade with head and shoulder pattern and make profit from price reversal. Trade with head and shoulder will enhance and upgrade your price action skill to the next level. I am going to make you familiar with different forms of head and shoulders such as horizontal, ascending, descending, and inverted pattern, and teach you how you can enter and exit the market and where you put your stop loss. This is an excellent opportunity for beginners to identify the high probability trading setup and make profit from the stock market. What is head and shoulder reversal pattern? Head and shoulder reversal pattern is one of the most versatile and dependable chart pattern tool on both stock and forex to include in any price action trading strategy. When this pattern is fully developed, it signals a possible downtrend bullish to bearish reversal as buyers in the market cannot push the price higher anymore. When inverted head and shoulder is fully developed, it signals a possible uptrend bearish to bullish reversal as sellers in the market cannot push the price lower anymore. This pattern appears on all time frames and can therefore be used by all types of traders and investors. Entry levels, stop levels, and price targets make the formation easy to implement as the chart pattern provides important and easily visible levels. Head and shoulder consist of 5 important elements. The first one is uptrend. The trend is going upward to form head and shoulder, and this is the first requirement. The second one is the left shoulder. It forms by the first pullback as the price is going upward. At this point, there is no indication the trend will reverse. The third one is the head. The market trades above the previous swing high, and soon after the sellers control the market and push the price down toward the swing low to build the neckline. The fourth one is the right shoulder. Once again, the buyer controls the market and push the price higher to nearly the same level as the left shoulder. And then the higher price was rejected by the sellers and the price dropped toward the neckline again. Finally, number 5, the neckline. This level, which is support and turn into resistance area, will become a key component of how to trade the breakout. Graphical representation of horizontal head and shoulder reversal. Let's assume this is a strong support area and the price is moving upward, have just a little bit pullback and strongly going upward, rejected by the support turn into resistance, and a little bit pullback and strongly going upward. So here the price making higher high, higher low, higher high, higher low, and again higher low. It rejected by the sellers toward the support area, and the first left shoulder is formed. The price again rejected by the support area and going upward, strongly upward, way up, and then again rejected by the sellers toward the neckline or support area. And here the head it produced. The price rejects again and again rejected by the sellers toward the support area. Now, this is the right shoulder that it's formed. The price continue going downward, break down the support area, going downward, have a little bit pullback, and retest the market structure, and going downward all the way, and here we have a strong downtrend reversal. Now, normally the traders, they exit the market at this point and put their stop loss above the resistant area, or support turn into resistant, about this area. So this is the stop loss, and also this is the neckline. Now I'm going to give you professional tip. So many times it happened that after the head and shoulder it formed, the market continue going higher. Instead of going lower, it goes higher rather than going lower. And your stop loss triggered and you were out of the trade. This happened for two reasons. The first reason, because the trend was so strong upward, even after forming the right shoulder here, after forming the right shoulder, the buyer was so strong and push the market higher. The second reason for that is the duration of this head and shoulder to form was not long enough to create a big downtrend force on break down the neckline. So the longer the head and shoulder to form, the stronger the possible trend reversal would be. Graphical representation of head and shoulder price action reversal with build up. Let's assume this is a strong support. The price is going upward strongly and rejected by the sellers. This is the left shoulder. The price reject again by the support and going strongly upward, and the sellers push the price down toward the support. This is the head of the head and shoulder, and the price move up and again reverse by the sellers. This is the right shoulder. After this, the price, rather than breaking down the support, it consolidate and going in build up, and the price moving sideways with a very low fluctuation. So this is the build up, and after this the price break down the support and moving downward all the way. This is the neckline area. Now this is the neckline area. Now in this situation, in this head and shoulder with build up, how you enter the market, how you exit the market here. Now the best place to exit the market is where the first candle closes below the support area. Then you exit the market and you put your stop loss above the build up. Some traders, they put their stop loss above the right shoulder around here or above the head. That's not a good idea, because your stop loss is going to be too wide and you're going to have a poor risk to reward ratio. I'm going to show you the real example of the price trend. Now this is only graphical representation, and in a few slides you see the real price trend example which clarify the situation. Graphical representation of ascending head and shoulder reversal. In a strong uptrend, the price always trending higher swing high and higher swing low. And this continue until the momentum coming to end or near reversal. In this situation, the trend is unable to make higher swing high anymore, and instead it makes lower swing high. This is the time traders should exit the market and put their stop loss above the swing high. I am going to demonstrate this in a real price trend in the next slide. I have also explained this in detail in my previous video, YouTube video, entitled Ultimate Beginners Swing Trading Course Lesson 4. Let's assume this is the dynamic trend line considered as a strong support area. The price is going strongly upward, and after a little pullback, it go up and break the resistant or support turn into resistant area, and going up and reverses by the sellers. So the sellers were strong in the market and pushed the price down and produced the left shoulder. The price again bounced back and going strongly upward, and again it got rejected by the sellers. This is the head area of the head and shoulder. The price again rejected by the support and pushed back by the sellers. This is the right shoulder which produced. Now the price broke down the support and strongly going downward without having a pullback or retest the resistance or the market structure. This is considered as ascending neckline. Now look what exactly happened here. Look what happened. The price is going strongly upward and make higher swing high, higher swing low, higher swing high, higher swing low, higher swing high, higher swing low. Higher swing high? No, it didn't produce higher swing high, because this point should be higher than this, should be around here. So cannot make higher swing high. So as soon as the price cannot make higher swing high, it means it break this structure. When it breaks the structure, then the trend reverses, or the trend momentum coming to end near reversal. So in this situation, the traders can exit the market here using price action, like for example shooting star if they see that there's a sign of reversal, or wait for the candle to close below this point and exit the market and put their stop loss 1 or 2 ATR above this area, above here. Or when the price break the support area, as soon as the price closes below the support, then they can exit the market and they put their stop loss 1 or 2 ATR above this area, above the support. Now this is very strong head and shoulder, because the support area is ascending neckline. It's ascending. This is very strong. So as soon as you see this, the support area is a trend line, you remember that, and ascending, remember it's a very strong head and shoulder. Graphical representation of descending head and shoulder reversal. This is dynamic trend line considered as descending support area. The price is moving upward, break the resistance and rejected by the presence of sellers in the market. This is the left shoulder. The price rebounds back again and again, rejected by the sellers, all the way to the support area. That is the head. The price again rebound, moved up and rejected by the sellers. Now the price also break down the support area and produces a right shoulder and move downward. This is the descending neckline. Now I would like to mention that this is a very weak, extremely weak head and shoulder, descending head and shoulder, and I warn the traders that stay away from this one, because most of the time it doesn't work correctly. So, but anyway, I explained this, but I warn you that as soon as you see this one, do not rely on this descending head and shoulder. Graphical representation of inverted head and shoulder reversal pattern. An inverse or reverse head and shoulder reversal pattern is also a reliable indicator that can also signal that a downtrend is about to reverse into an uptrend. In this case, the stock price reaches 3 consecutive lows separated by temporary rallies. The inverted head and shoulder indicated by the letter W and sometimes refers as W pattern. Let's assume this is very strong support and resistance level or area. The price started from here, coming down strongly, and after a little pullback, the price come down, break the support, and it got reversed by the power of the buyers in the market. It hit the resistance, and here it produces the left shoulder of the head, inverted head and shoulder. The price rejected by the resistance, coming downward, and again the buyers push the price back to the resistance. Again it produces a head, and then again the price rejected by the resistance level, bounced back again by the buyers' power in the market. It produces the right shoulder. The price break up the resistance and it had a little pullback and retest the support area and going upward, very strongly upward, and this is a strong uptrend reversal. Now I would like to tell you that you pay attention carefully to what I'm saying now. Look at the price. The price making a lower swing low, lower swing high, lower swing low, lower swing high, lower swing low, lower swing high, and again it cannot make lower swing low, because lower swing low, it should come all the way here. That should be lower than this point. So it cannot make lower swing low. So this break the structure. So it means the strong downtrend momentum, it's near the end or near reversal. So the trend reverses. Now if I were you, I would look for pattern and formations like hammer here, engulfing, and enter the market right here and put your stop loss below this point, 1 or 2 ATR below this point, and ride on a big trend. Or you could enter the market as soon as the candle closes above the support. As soon as the next candle open, you could enter the market and put your stop loss below the support. Now, or you can wait for the pullback and retest, and the next candle open, you could enter the market and put your stop loss 1 or 2 ATR below this retest or below the support. This is a very good video for beginners to be familiar with price action. I would like that you look at the trend and find this pattern and practice. I'm sure that if you use this pattern, you could enter the market and make good money. Ascending head and shoulder price action reversal pattern. This is the price trend, lowest corporation D1 time frame, and this is a strong uptrend and the trend making higher high and higher low, higher high and higher low. So that is the characteristics of strong uptrend, to make swing high and swing low, swing high, swing low. So this continue all the way to the top. So it makes swing high. You have to pay attention to this point, very clear, very good. So the trend is making higher high here, and then it makes higher low here. So the next one, it should be higher high if this uptrend continue. Look, it failed to make higher high. It makes lower high. That means that if it want to make higher high, this point should be around here. So it should be higher than this point. So it failed to make higher high, and instead of that, it makes lower high. So it means this strong uptrend is near end or near reversal. Look what happened. What happened after? The prices failed to make higher high, and instead it makes lower low, lower high, lower low, lower high, and lower low. So it means this is a strong uptrend and this is a strong downtrend. Now I want to show you how head and shoulder, I can draw head and shoulder here for you to know the concept of head and shoulder. First I'm going to install the neckline. This is the ascending neckline. This is the support area, dynamic trend line, ascending dynamic trend line. Now I'm also going to show you the left shoulder, right shoulder, and the head, and also the breakdown area where you can exit the market. Now look how you do that. This is the place that the price broke the support and coming down. So as soon as this bearish candle closes below this support area, you exit the market and you put your stop loss 2 or 3 ATR or 1, 2 ATR above the support. And that's how you approach this head and shoulder reversal pattern. I'm also going to give you a couple of more examples to clarify the head and shoulder reversal strategy. Head and shoulder reversal pattern with build up. This is the price trend GBP stock on a daily time frame. Now the trend is originally going upward, and this is the neckline and support area, which is horizontal support area. Now the price is going up and make the first, the price is going, it break the resistance and it go up and make the first left shoulder, and then it coming down, hitting the support, and again rejected by the support area and going all the way up, and here it make the head of the head and shoulder. Now again the price reverses because of the bearish power is strong and push the price down all the way to the support level, and again reverses back and form the right shoulder. And after that the price again pushed by the seller's power and hit the support, but this time instead of it going through the support, it start making consolidation or range bound and also build up. You see there is a huge build up here, and this is the build up and the upper bound of the build up. Now the price after that, it broke the support and going downward. So as soon as the price coming down, as the first candle closes below the support or below the neckline, you exit the market and put your stop loss above the build up. Don't put it above the right shoulder or above the head, above the build up. So that is maybe 1 ATR above the build up, and you exit the market. So that's how you approach head and shoulder reversal pattern with build up. Head and shoulder reversal pattern continue. This is the price trend, big sporting goods D1 time frame, and the price is originally going strongly upward, and I installed the neckline or support area. This is the left shoulder, and this is the head, and finally this is the right shoulder. The price break the support area and penetrate through and going strongly downward. Now there are three ways that you can exit the market. The first one is in a right shoulder on the top here around this area. You may find pattern and formations like bearish engulfing, shooting star, bearish tweezer top, and so on, and you exit here the market, and you put your stop loss 2 or 3 ATR above this area, above the right shoulder. Or you can use this area. As soon as the bearish candle closes below the support, you can exit the market and put your stop loss to 1 or 2 ATR above the support. And or you wait until this pullback occur and the price retest the area, the neckline, and as soon as they retest the neckline and going downward, you exit the market here, and again you put your stop loss 1 ATR above the support. And this is how you approach head and shoulder reversal pattern with pullback. Head and shoulder reversal pattern continue. This is the price trend, BlackRock Energy D1 time frame. The trend is going upward, and this is the neckline or support area, and this is the left, right, and head of the head and shoulder, and the price break down the support at this point and it's heading downward. Now, as you see, the price break down the support and going downward and close it here, so you can exit the market as the price closed here and you put your stop loss above the support. Or you can use pattern and formations. If you find pattern and formations here, that you make sure that the trend reverses, and then you exit the market here and you put your stop loss above the right shoulder. This is how you approach. But another things that I mentioned earlier, that there are two factors with head and shoulder. One of them, if the trend is very strong, then sometime when the right shoulder form, the trend may not reverse, downward, may go straight upward, and whoever exit the market, it triggered the stop loss and they are out of the market. And the number two is, if the duration of head and shoulder to form be short, then you may get a false signal, false reversal pattern. So these are the two factors that is very important. So the longer the duration of the head and shoulder to form, the stronger the reversal would be. That's all, folks. If you like this video, thumbs up and subscribe. Thanks for watching. Take care and see you next time.